Hello everyone, welcome back to the channel. This is Sushit and very happy to come up with another video for you all. If you are an NRI or OCI planning to move back to India from the United States, this video is tailored for you all. Joining me here is CA Mohit Gopwani, a seasoned tax expert handling more than 10,000 NRIs, supporting them with their tax planning in India. Together, we will dive into the key areas you need to address before making the big move. Managing your US investment or handling bank accounts and simplifying your taxes. It's not that easy, but with our conversation, we will try to make your decision making easier in these cases. So, Mohit, first of all, very happy and good to have you over this call.
Thank you, Sushit. Thank you.
So, Mohit, without taking a lot of time, I would be very quick on why this planning is so crucial when it comes to moving back to India.
Right. This is actually a very important discussion point because just 3 days back, there was a client who reached out to me through SBNRI itself. So this person had shifted back to India after 27 years. He had been living in the US for 27 years and he had shifted back to India. And he did not have any awareness of the fact that, his foreign income in future years will be taxable in India. See, because a lot of times people coming back from the US continue holding their US investments and the US bank accounts, and these will start attracting taxes in India, once they become a resident. So it is very important, to be aware of the fact and be aware of the laws that are going to apply to you, and then accordingly plan your, shift. Such a big shift could have significant tax implications and significant penalties if you don't comply with the laws correctly, right? So therefore awareness is extremely important and planning according to it is very, very important.
That's a great point, Mohit. Let's try to break it down. So, starting with investment, what should someone do about the investment which they made in the US before moving back to India? What about those investment? What are the calls they should take?
Well, see, good news is that they are actually allowed to hold those investments in the US, right? As an individual, if you were working in the US and you want to continue holding those savings in the US, or whatever investments you did at that point of time, they can continue holding those investments in the US. The only drawback is that once you come back to India and become a regular resident, then your US investments, whatever income they are giving out on an annual basis or the capital gains, these incomes will start attracting taxes in India. So you're allowed to hold your investments, but you have to be compliant with the taxes in India.
After the calculation of tax residency, right? But how exactly are people determining this tax residency?
Well, so see, residential status is a slightly complicated concept, and different laws have different definition of an Indian resident. So FEMA has a different law which gives a different definition of a resident. The Income Tax Act defines a resident in a different way, but we'll mainly be dealing with the income tax for this question. So, as soon as an individual spends 182 days in India in any financial year, then he becomes a resident of India for that particular financial year, right? And once you become a resident,
Mhm.
then your global income becomes taxable in India. Given that scenario, there are exemptions available for people who are coming back to India after a long time, right? So there is a 2 year period wherein even when they come back to India and spend the majority of the year in India, they still will not be required to pay taxes on their foreign income in India. So there is a 2 year exemption, but after that you become a regular ordinary resident and all your global income will start attracting taxes in India.
Okay, got it, got it. So basically, 182 days, if they are completing in one financial year, then they have their tax residency as a resident Indian.
Exactly, exactly. You become a resident, but for the first 2 years, you're given a relief wherein, if you want, your foreign passive incomes will not be taxable in India. So your foreign interest income, dividend income, foreign capital gains will not be taxable, because a
Fine.
lot of times when people come back, they are in two minds, and this is a great benefit.
Mhm.
So for the first 2 years, you can use that, and if you want to wind up your assets over that point of time, that can be done without attracting any taxes in India. But of course, even if you want to continue holding them, that is all right. it'll just start attracting taxes in India after the 2 year period. Yeah.
Well noted, Mohit. And about this, you know that in the US there are 401k, IRAs, Roth IRA accounts. So what needs to be done about that when they move back? I mean, they are obviously not employed in the US anymore. So what happens to these accounts?
See, again, they can continue holding their 401k and IRA accounts. Generally, these are accumulated when an individual is working in the US, and they are allowed to hold them over there. Specifically, with these accounts, if they withdraw it before a certain age, before the age of 59 and a half, there can be penalties that get attracted. So, generally speaking, it is always better to continue holding them, and once they attain the age of 60, they can then withdraw it. There are actually some exemptions available under the India USA double taxation avoidance agreement,
Hmm.
wherein even if they've become an Indian resident and they withdraw this after becoming an Indian resident, there are multiple options. They can withdraw it as a lump sum, or they can go for a pension or an annuity. So there are exemptions that can be availed under the double taxation avoidance agreement. Yeah.
Okay. So they can continue up to say the maturity period, which is 59.5 years, and post that they can redeem these funds or they can withdraw it.
Absolutely, absolutely.
All right. And uh, about the bank accounts, so they will be moving to India, and they have like in most of the cases, NRIs and investors, they have like multiple US bank accounts. So what needs to be done with these accounts, with these bank accounts?
Well, see, ideally, if you're going to be holding any investments in the US, right, then one bank account at least would be needed, right? Because at any point of time, they want to, liquidate those investments, or make further investments. So it's always better to keep one bank account active in the US if there are any existing financial investments that they're going to continue with, right? Also, it is important that if you're closing any bank account in the US, right, and you're
Mhm.
coming back to India, then it's always better to keep your bank statements in your records, right? Because a lot of times when people come back to India and bring all their money back from US to India, there could be questions from the tax authorities regarding the sources of finance, right? As to where did they get all this money. So it is always important, if they have their bank statements and records, they can always prove that this was foreign earned income, and when they come back to India, they can bring it back without any tax implications. Yeah.
So I think the same criteria should be there for credit cards also, right? That they should keep one and close the rest.
Yeah, ideally, see, if you're having investments and bank accounts, then you can hold one credit card, but it's always better to reach out to your bank and let them know about the fact that you've actually shifted back to India.
Mhm.
And if the bank allows holding them, or allows them to hold a credit card as a non-resident, then it should be completely fine. Yeah.
Okay, understood. So another piece, and it's an area which is like little complicated, which is the taxes. So taxes are oftenly the trickiest part. What should NRIs know about managing their tax obligations after moving back to India?
Well, you're right. Taxes is an important part, and a lot of times people have this complaint that since they've earned the money in the US and they've just come back to India for retirement, then those investments and income from those investments should not attract taxes in India. But generally, this is not just about India, but this is a rule followed globally across the world, that once you become a resident of any country, then you're required to pay taxes in that country on your global income, right? So India follows the same rule, US follows the same rule, across Europe, Australia, everyone, all the countries follow the same rules. So again, when you come back to India, so it is important that you clearly know what category you fall in, what category of residential status you fall in, right? And it is important to note that the citizenship here does not matter much. It is mainly dependent on your residential status. So once you come back to India, you become an Indian resident, your global income is taxable. So but there is a relief under the India US double taxation avoidance agreement. So if
Mhm.
you have any income in the US which is getting taxed in the US, and that again gets taxed in India on account of you being an Indian resident, then whatever taxes the individual has paid in the US will be available as a credit in India. So I'll just give you a quick example. So if a person coming back to India has say 100 USD income in any year, right, and he's already paid 10 USD as taxes in the US, and
Mm-hmm.
say India taxes that income at 15%. So given that he's already paid 10% in the US, he only needs to pay the differential 5% taxes in India. That is it. So he need not pay the entire 15% taxes again, right? Yeah.
And
So
that
this
is
is a benefit available under the DTAA. Yeah.
that is same under capital gains also. So if there is any investment in the US which is being taxed, let's say at 20%, and in India it is taxed at 25%. So in that case also that the same logic is applicable under DTAA.
Absolutely, absolutely. Also, again, with respect to capital gains, a lot of times the query comes up is the fact that they made the investment when they were NRIs, and now once they come back they become residents. So will that affect? So that actually has no implication because the tax liability with respect to any capital assets arises only when you sell the assets, right? When you're investing into the assets, there are no tax implications. So once you at the point of selling, if you're a resident, then they will be normally taxed as a resident. And again, any taxes that they've paid in the US will be available as a credit in India. India has actually significantly reduced taxes on long term capital gains.
Mhm.
It used to be 20% earlier, but they've brought it down to 12.5% in the most recent budget. So that is actually a huge advantage to people across the world for who are investing in India. Yeah.
Yeah, it is. It is. And it is so simplified nowadays after the new budget.
True, they've done away with a lot of complications that were there earlier, and a lot of classifications with respect to long term, short term. They were for different asset classes, there were different periods of holding when an asset could become long term or short term.
Understood. Understood. And since you are saying that they have their liabilities in the US as well as India, because now even if they are getting converted to a resident Indian, but they have their investments and bank accounts and earnings from the US, therefore it becomes a mandatory for them to file income tax return in the US also, right?
You see, again, with respect to US tax filing, it will be best if they can reach out to a tax consultant in the US, or I'm sure at SBNRI, you have a tax US CPA as well who can give them an opinion on this. From an India tax point of view, I can let them know that once they become an Indian resident, extremely important to report their global assets in their Indian income tax return,
Mhm.
and report their global incomes and file taxes on that. And of course, exemptions that are available under the India US DTAA will be available. So the tax implication is generally not too high because of the DTAA exemptions here.
Well, noted, Mohit. That's great and good to know. Now, you know that most of the NRIs living in the US, they have their investment exposure not only in the US, but Indian market also via their NRO and NRE accounts. So when they get converted and they come back to India, what how do they manage those investments which they made via NRE, NRO accounts?
Right. See, ideally, in these cases, when an individual is coming back to India, and if they are sure that they're going to be in India, then ideally they should convert or update the KYC and let their banks and all their investment accounts let them know that the fact that they've come back for good and they've become a resident, that actually also helps them in avoiding TDS, because NRIs of course have to face a large amount of TDS on their liquidations, right? So it's always better that whenever they come back, update their KYC, let everyone know, banks and all the financial intermediaries, that they've become residents, and they can then convert their NRO NRE accounts to regular savings accounts and
Mhm.
continue holding those. If at all someone wants to hold some foreign currency,
Yeah.
then that can be done through RFC accounts. There is an option of holding resident foreign currency, RFC accounts with banks. So that can be done. If they want to bring back some money from the US, but they still want to hold it in USD, that can be done through an RFC account as well.
Okay, okay. So RFC that gives another opportunity for them to hold the abroad the US currency.
Right. Exactly. Exactly. Yeah.
Okay, okay. Perfect. That was super helpful and insightful, Mohit. Any special tips which you want to share with the NRIs who are planning to move back to India?
Well, the most important tip is, be aware, right? A lot of people actually, are generally not aware of the laws. So it is very important that, you actively reach out to tax consultants who specialize in this area and understand what are the laws that are going to apply to you, and accordingly plan, your shift. So, I'll just give you a recent example. There was a person who wanted to shift back from the US, but he actually reached out to us before shifting back, right? So we were able to plan his return to India in such a way that his RNOR status could be extended. Instead of 2 years, he got a 3-year period where, he got the RNOR status. So, and it seems that 1 year will not have a huge impact, but that led to a tax saving of about 15 to 20 lakhs. So these things can have a major impact. Therefore, always better to, be proactive about these, reach out to consultants, be aware, and then plan accordingly. Yeah.
Absolutely, Mohit. That was really very helpful, and thank you so much for your time and expertise. And thank you everyone for watching this video. If you found this video helpful, don't forget to like, subscribe, and share it with others. Let others know also about these problems can be solved if they are actually planning this in advance. If you want to know something specific related to this video, just drop a comment, or for any assistance related to your tax planning or financial support, you can download the SBNRI app. From there, you can get in touch with our team. Thanks a lot and have a lovely day. Take care.
Thank you, Sushit.